the notion that 2.5% 5-year, I like to look at the 5-year note a little bit better than the 10-year because it's a little bit less direct interest rate risk. And I think mom and pop investors, if they could have bought a 2.5% 5-year note 3 or 4 years ago, you know that they would have been just falling over themselves to buy that. And now they can, and yet the momentum is still scaring them away. So I think what's happening is that you'll see a greater level of interest as we get greater levels of volatility in the equity market and other risk assets like high yield and bank loans and maybe even emerging markets. But the way things are working today, I think the equity market is the third derivative. I think interest rates are the second derivative, and I think the first derivative is a change in policy from $15 trillion of QE stimulus by the 3 major central banks to now we're actually moving to a QT environment. And I think that changes the rules of the game from what we've been used to in the last 7 or 8 years.
Doug, is that why interest rates are going up? Or is it, other people argue, no, it's because the economy is getting better? Or
well, I think it's a combination.
Or are the bond vigilantes fearful about all the debt that's going to be issued?
I think it's a combination of all those things. But don't forget, we had a lot of debt. We had big deficits. And when the QE was alive and well, interest rates were falling. And so now we're going to have greater growth. There's no doubt about that. We can argue about inflation. I would argue that actually we did see inflation that was caused by QE. We just didn't see it in the consumer price index or the core PCE. We saw it in asset prices. And everybody now is worried we're going to start to see some goods price inflation or some service price inflation. I think that's probably appropriate at this stage of the economic cycle.
But the question, Guy Adami, is how do you factor in what seems inexorable, which is what's going to happen to earnings here, right? And also what Michelle talked about, which is the economy. It looks like we're ratcheting up a 2.5% economy compared to a 2%, maybe even a 3% economy. All the earnings have been outstanding, and all the other stuff, to my mind, Guy, is noise compared to the actual earnings and the earnings outlook.
I agree, and I don't think the stock market, the fall in the stock market over the last couple of days should not affect earnings at all. Earnings have been very strong. They should continue to get stronger. Look at what the GDP forecast went from 4.2% on Friday to 5.5%.
No, it didn't.
Well,
that's a stupid forecast, but that's another story.
It's a stupid forecast, not stupid forecast.
No, it's totally stupid, but go ahead.
It wasn't my forecast.
No, so don't repeat it. Yeah.
Fair enough. But you understand.
Towards the highs again, really on what I would see is not very good volume, and the fact of the matter is that we're seeing some serious volatility in the market, which I think bodes not particularly well as we move forward.
All right, so you mentioned 2 things here. You're watching volume, you're watching volatility. What other signals do you have your eyes on, Dan, that will tell you what we could be in for next?
If you look at the Dow for a longer term chart pattern, if you look back over the last year and a half, there has been a chart out there circulating the last couple of months that it looks very similar to the 1929 chart that they saw. So, I mean, that's, I think, playing into some traders' minds as well, as you see.
The time period is exactly the same time period.
That is incredible, really, when you look at it. It's chilling.
It really is, because
we joke about it,
we're
but it's
just about to go up.
As they do, and then it went straight down.
So so April 2nd, 14 is really the bottom of the crash.
And if this chart were to hold up, it would drop from over 16,000 where it is now down to somewhere in the 12s, it looks like. That would be significant.
Yeah.
Purpose is to make, people that tell fortunes look good, because they just don't know what's going on. So, but what I did try to prove in this book is what the facts are. So here's a couple things you should know. Number one, there's a new high on average every month. Most people have no clue. So you hear, oh, it broke records, it broke records. we're in a situation right now that's very artificial. It's a situation where the feds around the world have been printing money. So nobody knows what's going to happen. There's this tremendous fear that's in the marketplace. So what I wanted to show people was, look, when the crash comes, first of all, a correction comes every year. I don't know if you remember last January, the world was ending. The market lost $2 trillion in January. It was the worst January ever.
Yes,
Do you
I remember that.
And we ended the year a total record-breaking year again. So obviously there are going to be corrections. They happen every year since 1900. The average one is 2 months long, and it costs you 14% if you sell. But if you don't sell, you're fine. There's a bear market about every 5 years. We've gone 8 years without one. That's why I wrote this book, because I want to show you how to protect yourself when that bear comes, but more importantly, how to take advantage of it, because it is the greatest opportunity in your life to leapfrog from where you are to where you want to be. Let me explain why. If I told you, if your favorite car was, let's say, young man, what do you like? And you say, I love Ferraris. They're on sale for 50% off. You'd be pretty excited. The stock market's the only place when things go on sale for 50% off where everybody panics. See, Warren Buffett looks at it and goes, this is the greatest opportunity of my life. He tells everybody to do this, but everybody else panics. What you need to know is that every bear market that's ever come, they average a year. They usually cost 33%, but if you don't sell, they don't cost you anything. And in 2 centuries of American history, please hear me if you're listening at home, in 2 centuries, every single bear market was followed by a bull market. Everybody remembers 2008. Oh my God, the market dropped 35, 40, 50% at peak to trough. It went up 69% the next 12 months.
What happens if you don't have the money to invest in the market? I mean, you got a few bucks, you put it in the bank. You know, how much should you invest in the market? How can you get your foot in the door?
Well, all the answers I'm giving you, by the way, are not my answers. I interviewed 50 of the smartest financial people in the world, from Warren Buffett to Ray Dalio to Carl Icahn. But the answer to your question is, you have to become an owner and not just a consumer. If you own an iPhone and you don't own Apple, and not just Apple, but American business, you're making a giant mistake. Now, people say, but I have no money. And I think I shared with you when I was on before, there's one of my favorite examples is a man who grew up in the 1950s, worked for UPS. His name's Theodore Johnson, true story. He never made more than $14,000 a year, but he retired with $70 million, and he gave away $35 million while he was still alive. How is that possible? He understood the power of compounding. A friend of his said, I'm going to put a 20% tax on you. And he goes, I can't live on less than $14,000 a year. He said, listen to me. If the government passed another tax of 20% more, you'd scream, you'd yell, you'd complain, and you'd pay it. And you adjust to it. He said, this will make you wealthy. So what people have to do is take 5 or 10 or 15 or 20, you build it through time, and you got to put it aside and have it automated. So you don't see it, it goes into an investment account. Then where to put it, this book shows you by walking through those elements. But what I want people to know is, if you're a millennial and you're full of debt from college and you think you'll never get out, this will show you exactly how to get out. And the best time to get out is when things break down, because that's when the opportunity is going to be there.
With his first year in office drawing to a close, the U.S. president has been talking up his economic record in typical Trump style.
Economic miracle. Created more than 2 million jobs. Unemployment is at a 17-year low. The stock market is at an all-time high. Fantastic for the economy. Our economy has already surged to 3% growth. Unemployment is at a 17-year low. Liberated the American economy. Our economy is doing fantastically well.
But one man who does not share President Trump's optimism is former U.S. Congressman Ron Paul, and he joins us live now from Texas. Always a pleasure to have you on the program. So what do you make of Trump's record? Why, in your view, is it not perhaps as positive as the figures seem to suggest? His supporters would say the stock market's going up, jobs are being created. Is that not worthy of praise?
Well, if we're all true, there's partial truth there. Things are a little bit better. If you're in the stock market and a wealthy person, you're doing quite well. But what we're forgetting here when we listen to this rhetoric of all this optimism is that there's a large segment of our population that's having a difficult time. We have 2 types of society here, the lower 50% and the top 10 or 15%. And the economy is doing well for the wealthy, but not for the poor. And where there is prosperity and more jobs, it depends on debt. Yes, an individual can feel very good if they have a line of credit to the bank, but eventually that line of credit runs out. We in this country benefit because we have the reserve currency of the world. We can run up a lot of debt and we can spend a lot of money. And even with that, we've had a great deal of difficulty in these last 8 years trying to get out of the recession. And I quite frankly don't believe we're really out of that recession. But believe me, we have a lot more debt. It's self-limiting, and I think before this year is out, the amount of debt that we have is going to be a great burden because interest rates are creeping up. And all of a sudden, that's going to make our budgetary problems very difficult to handle.
You went further than that in an interview recently, saying that the system is coming apart, very direct language. What did you actually mean by that? Because there are those who would disagree with you, saying that the impending economic meltdown is always coming, but the system just keeps going on, does it not?
Yes, that is true. In Austrian economics, which I follow, which is quite a bit different from Keynesian economics or socialist economics, it teaches that you can see the direction of an economy and predict, bubbles, but you can't predict timing. We do know that if you have a central bank